Let's ask Adam Parker. He's the founder and CEO of Trivariate Research, a CNBC contributor, with me, as you can see, at Post 9. Welcome back.
Great to be here.
It's really hard to try and game out the election and what you're supposed to do. So let's try and, I guess, look beyond. Is the backdrop for stocks, no matter what happens on Election Day, still positive?
I think so. I mean, the question is, do you get a growth scare that gets people afraid 2025, 2026 earnings are impaired? Probably not. I think the bull case is still intact, right? Gross margins are going up for a lot of companies. You might get a positive skew out of China stimulus. You see how NVIDIA acts. You might get some more case studies that there's productivity from AI deployment. We're probably going to run a pretty big deficit next year, no matter who wins. So that usually finds its way into the biggest 20 or 30 U.S. equities, trickling its way down. So, yeah, I think the setup's still skewed to the positive, and the bull case is still intact, unless we get, a new policy from a new political regime that looks like it's going to be more austere, and then maybe you change your mind.
Well, what happens if, we do run the deficit that you suggest, which, obviously we have a sizable deficit, we have to fund it and all that.
Right.
What happens if that causes yields to back up further?
Yeah, I mean, the bond vigilante kind of scare thing is always out there. It hasn't really sustainably happened in the last 15 years, even though I hear about it periodically. It's in the distribution of what people talk about.
You think it's overblown? Overplayed?
Usually when people really get nervous and it's risk-off trade, bond yields go lower. I mean, that's kind of easier to show than it is that we're going to have, fear about the health of the U.S. financial system and bond yields are going to back up. So if I look back in time, and I look at there's a lot of supply coming online, it won't be bet to demand, I'll make this call that yields are backing up. Usually it doesn't happen that way. If I go back to QE1, QE2, QE3, twist, torque, repo, every time the experts would say supply's coming, and every time yields went lower because when the world was a riskier place, people got nervous and they bought the 10-year. So it could be different this time, but the institutional investors I talk to, all focused on equities, they're not really positioning. I mean, I guess what I'd say is, that's been a moving target. I remember years ago people say, once we're at 3% on the 10-year, U.S. equities can't handle that. And then it was 3.5, and then it was 4. Now, what is it, 5? People were saying.
Well, the 10-year's at 4.31. What if it does move towards 5?
I think if it's because growth is better than people think, it's okay. I think it's because the consumer hangs in, it's okay. I think it's because people are worried about stagflation, then that's, no bueno.
All right, so as long as we have margins that are good, productivity that is rising, and the Fed's cutting, and the Fed, by the way, cutting not through sort of historical precedent, I guess you could say, where it's not like the labor market is deteriorating to where the Fed has to start cutting rates. So maybe this time is different. Those three things, margins, productivity, Fed cutting, among a few others, if you wanted to put them on the list, that underlays the bullish backdrop.
I think so. And I think, if you get some news out of China, then all of a sudden, if you're short equities, you're saying, I don't care about margins going up. I don't care about the Fed still being in the first half of their path. I don't care about a massive deficit, and I don't care about China stimulating a ton. I mean, you're starting to really put together some, you better be right that people are afraid of a growth scare in the next few months. And then in most years where the market's up this much in the first 10 months of the year, it tends to actually follow through in year end also, just because people are chasing that performance and, that fear of missing out thing. So even trading wise, usually when you're this strong, Jan 1 through October 31st, you end up with an up November, December too.
What do you like the most in the market?
There's so many things.
Really?
Yeah. I mean,
okay.
Yeah.
Let's list a few.
Sure. I like healthcare services. That could be everything. They have pricing power, and they're going to grow next year. Unless we get a massive recession, things like UNH just tend to earn more money. I think the semiconductors I like a lot. I don't believe that the story about compute growing above GDP is remotely over, and that's not just NVIDIA. It's the whole semi-cap equipment space. It's
like AMAT, Lam,
Lam. Yeah, it's also Cadence and Synopsys, which sold off a lot. ASML kind of blew up because they're Samsung, but I think ultimately these companies are going to earn a lot more 2-3 years from now. They are now. I think it's a little bit less the diversified companies like Analog Devices and Texas Instruments and Microchip, just because they have more broad-based industrial and auto exposure. That may be a little longer to burn off their excess inventory. But there's plenty of things to own in semis. I think there's things to own in housing and and building materials. If we're short structures, whether it's multifamily or single family, I probably want to own building products. Owens Corning bought Masonite. There's doors and there's insulation. You can buy BLDR. You can buy stocks that have blown up that probably have better earnings going forward. Mohawk, Beacon Roofing, Florida. There's tons in the housing exposure sector. Probably power. I mean, you look at the stuff with Amazon you're talking about in the previous program, but definitely you're going to need more power, whether it's nat gas or others. We've had choppy stocks today, but I think if you look a year from now, they're going to be up. So power, housing, healthcare services, semis.